Hello, everybody, and welcome to our latest edition of GlobalView, presented by FrontierView. Delighted to be with you today and looking forward to an interesting conversation. As a quick intro, for those of you who are not familiar, FrontierView is part of FiscoNote and is an advisory and research firm focusing on supporting multinationals with their critical global growth challenges. We work with over 300 multinationals globally, powering their strategic planning, market monitoring, and executional support. And we work with clients across Asia Pacific, Europe, Middle East and Africa, and Latin America, across industries such as healthcare, consumer goods, B2B industrials, and technology. So we bring to you today not just our point of view on the world, but also what we're hearing from clients as we work with them in supporting their planning processes and executional priorities as well. Today, I'm joined by a special guest, Mark McNamee, our Director for Europe Research. Hi, Mark. Thanks for joining.
Hello, Martina. Thank you.
Hello. And we'll talk about two topics today. First, I'll give a very quick update on how the global story has changed over the past month and a half. And there have been some changes for the better, which is great news. And then we're here to really ask Mark a bunch of questions about the outlook for Europe and some of the things that have happened in that region, especially as companies are thinking about where is the outlook improving and what does that mean for Europe's picture, which is very complicated. But just to get us started, I wanted to share just a couple of things that are a little bit new from our perspective. First, we have a set of assumptions about what companies should build into their base case plans for this year that are broadly the same as they were, say, late November, December, when many budgets were finalized amongst our clients, including expectations that inflation peaked in last year, but it's still going to remain quite elevated this year. We are not seeing a very clear end in sight for the Ukraine war and the kind of Russia's invasion. Mark will go into that in a little bit more detail. We expect to see tight monetary policy by the Fed with Forex and credit cost implications for companies, consumers, and businesses. And we expect to see input costs, especially on the commodity and energy side, remaining fairly elevated. The one big difference is that we were expecting, as were many others as well, that China would be much more careful and gradual in reopening from zero COVID, and that is not what has happened. In fact, we have seen a very dramatic shift away from the zero COVID policy by the Chinese government, and we expect that to result in a couple of things. First, we've seen some disruptions to manufacturing and activity on the ground in Q1 as a lot of people have caught the virus, and there's been a human impact and disruption coming from that. But we expect to see growth really accelerating into Q2 and seeing a lot more people traveling, going out to restaurants. Local services consumption is maybe the way to think about this. And the very beginning of a bit of a travel reopening as well, although we expect that really to accelerate into the second half of the year. So for companies and countries that are looking for those Chinese tourists, we expect to see a lot more of them into the second half of the year, really. And all of that has resulted in higher expectations for growth and a little bit of an uptick in terms of the timeline for when we see the global recovery really starting to take shape. We were expecting and still expect that Q1 is going to be probably the low point. We're seeing still pressures on European growth. China, of course, not fully yet realizing the benefits of reopening from zero COVID. And the US is resilient, but slowing down. So we're definitely expecting to see a little bit more of a slowdown in activity in all of these major markets in Q1, probably bottoming out by Q2. And really in Q2, starting to see China pulling us out of that slowdown and into the second half of the year, where there are many reasons to be a little bit more optimistic about it than we were, 12 months ago or 6 months or even 3 months ago. So there is some good news there for multinationals. The conversations we're having with clients are still open about, okay, how do we factor that into our expectations and how do we deal with, maybe we're a bit more optimistic, but not right now. And right now we're seeing a slowdown in sales or slowdown in demand. And those two things are both true. So we expect to see the impact of the high input cost as well as pressure on consumers and businesses from last year really starting to take shape into demand in early 2023. But at the same time, we see a way in which this could improve, and it could improve meaningfully towards the second half of the year. So important to be hesitant and careful now, but also to be really ready for recovery in demand in H2. And finally, just to give you a bit of an illustration on what the forecasts look like, we've revised up our China forecast for this year to 5.4%, quite strong. Parts of Southeast Asia, India look very strong still. And even for the US, we've revised the forecast up a little bit. So overall, we still expect a significant slowdown this year, but it's actually an environment where we're seeing a little bit less pessimism as a result. So this maybe was somewhat good news, but I did want to move here to the conversation around Europe, because we're seeing a very significant challenge in interpreting what is happening there. So one of the questions, Mark, that we're getting from clients is, we thought there was going to be an energy crisis in Europe, but it looks like it hasn't happened. Gas prices on the wholesale market look like they're lower. Does that mean inflation isn't going to be as high? Please help us understand this crisis we expected to see in the winter has not materialized. Why is that? And also, what is actually happening on the input cost side? Because that's also very confusing for a lot of companies.
Sure. So as you mentioned, it's a common question. It depends on how we define the term crisis and what we're actually talking about, right? So first of all, the levels of inflation driven by the high energy prices are still historically high, right? So we didn't actually escape we escaped the worst downside scenario, but we are in a better place compared to where we were worried about being 6 months ago. So that's sort of the first answer. The second part of this, though, relates to how did we get into a better position compared to where we were? One, a lot of luck. It was windier and it was warmer this past winter, right off the bat. Also, the US was able to export more LNG than initially anticipated, and Europe was able to put in some installations to receive more LNG than was initially anticipated last summer as well for this winter. So all of these factors helped out a lot. A good amount of business and consumer reductions in demand, but then also, unfortunately, we did have problems. You saw fertilizer businesses going out of, fertilizer companies going out of business, a lot of impact of glass makers across a number of chemicals sectors. So if you ask those firms, they would have said there was a crisis, right, this past winter. So it kind of depends on perspective, but all else, sort of held equal here. We got through the winter in a better shape than expected. And now, of course, moving into this summer and next winter, do we get enough gas storage, as we're going to have a continued problem for next winter as well.
Got it. So that's very helpful, Mark. We got lucky, and that's no way to plan. Right. Maybe you will, maybe you won't, and if you don't, then you need to be ready for the risks. Do we still expect recession in Europe this year?
It depends on the market. But expect across the entire Europe portfolio, expect effective stagnation. Now you're going to have very mild recession in Germany, somewhere in the area of minus 0.5, maybe a little bit worse. UK unfortunately will be a worse laggard with all of the issues that Europe has, plus some of the Brexit pressures still on the UK economy. Sorry, I meant to say UK. So UK will decline by about 1%, but then you do have some good news. You have pretty consistent, strong performers out of Poland, Romania, Spain, should all grow by about 1%, perhaps even more. Italy will stagnate roughly. France will likely avoid a recession, have mild growth. So all in all, again, these numbers aren't setting the world on fire, of course, but better than where we thought we could be for 2023 several months ago.
That's very helpful. So maybe a market by market evaluation of the demand dynamics is the better way to go there. Okay. Last question, which I know you could talk about for an hour, but I'm only hoping for a minute or two, Mark. What should executives monitor as it relates to the war in Ukraine over the next month or two?
Sure. So you're going to see massive offensives. So clients continue to use the word sort of stalemate that we've seen since about last November, but it has been anything but a stalemate. There's been extremely aggressive assaults by both sides pretty consistently this past winter, but it has been more defined by the reconstitutional forces that we've seen on each side, the Ukrainian and the Russian side, respectively. So we are now seeing those forces more or less getting into place, ready to conduct an offensive, each of their own. It appears that Russia will likely be able to initiate a major offensive. It looks like they've already started to an extent down south towards Zaporizhia region in the south as you approach sort of Mariupol, Melitopol, but nothing major yet. That's expected in the coming weeks. Can Ukraine, of course, sustain that? And then if they're able to make a massive counteroffensive, which the expectations that they will try to assuredly with, of course, the other major development this past winter, with the provision of not just tanks, but actually probably more critically, the armored vehicles, all of the infantry fighting vehicles, the Bradleys, the Mardars from Germany, et cetera, et cetera. The point being that each side is gearing up for this massive offensive. And so at the end of the day, what's going to happen here in the next 2 to 3 months will be determinant for the trajectory of the war for the long term. Now, we still sort of believe in our base case that most likely Ukraine will be able to advance to a degree, pushing within Russian-held territory within Ukrainian borders, but not actually to fundamentally win the war, but just basically move to a new stabilized line of contact as we approach the summer. That's the base case expectation. I would say the next likely scenario would be an actual Ukrainian victory, which again, we don't think that is the base case by any means. That is a improbable, but still relatively likely scenario. And then the least likely scenario would be more or less an all-out Russian victory, whatever that actually would in fact look like. But in either case, expect massive uptick in violence in the next couple of months here, and a new sort of status quo as we approach the summer.
That's very
the
helpful,
point being,
Mark.
of course, for businesses to look out for, of course, would be how could Russia retaliate, particularly if Russia is seen as losing the war. Again, you start worrying about use of non-conventional weapons, as we were concerned about late last year, as Ukraine was making advances at that time. And then also, of course, further cuts to gas exports to Europe, further cuts to oil exports as well, which Russia just this past weekend, as you saw, of course, plans to cut oil production starting in March by 500,000 barrels per day. So, of course, some of the negative impacts we could see in energy markets again.
Got it. So I was hoping we would finish on a positive note, but maybe this is not the note to finish on. So for those of us listening, I would say slightly more optimism on the global growth outlook at this point in time. Also pending on how the situation evolves, as you said, in Ukraine, because that could be a potential factor derailing some of that recovery, certainly in Europe. More optimism in Asia, especially China, and maybe Europe has a little bit more upside this year, but it really depends on how the next couple of months play out with the war in Ukraine.
Right. And another positive is that the euro and a lot of global currencies have performed much better since the end of last year. So the euro, we've actually revised our forecast for a little bit more strength in the euro against the dollar and against all global currencies. So that, of course, helps with the imported inflation prices and things like this. So a little piece of positive news to leave people with.
Thank you, Mark. Thank you very much, everybody, for joining us as well. If you would like to hear more from us, certainly reach out, and we look forward to seeing you next month for our next edition of GlobalView. Goodbye.
Thank you.